Welcome to Talk Tickers.
Glad to be here for this one.
So, the last time you sent money to a friend on a Saturday night, you saw the balance update on your phone, right? And you probably assumed the cash actually moved.
Oh, absolutely. Everyone thinks that.
But it didn't. You were looking at basically a digital hallucination, just a user interface trick, an IOU. Because the actual money didn't move until a batch file cleared the Federal Reserve on Monday morning.
Right. The money was literally just sitting there waiting for the bank to open.
Exactly. And look, if you are managing capital, understanding the architecture of how money physically moves, it's not some academic exercise. It is a fundamental prerequisite.
Oh, for sure. You have to know the plumbing.
Right, because you need to understand where operating margins are going to compress, which legacy fee pools are about to evaporate, and honestly, where the new infrastructural monopolies are being built.
And that plumbing is undergoing a massive, painful shift right now.
Yeah. So to summarize what we are looking at on today's deep dive, the U.S. financial system is currently transitioning from that legacy batch processing to instant 24/7/365 settlement.
Which is a huge deal. The velocity of money is fundamentally changing, and our infrastructure, it just was not built for it.
No, not at all. So we're going to break down how instant settlement systems like FedNow and the RTP network actually function at the database level.
Yeah, we need to get into the weeds on how they actually talk to each other.
Right. And more importantly, we are going to answer the multi-trillion-dollar question, will these new real-time rails actually rip and replace the automated clearinghouse, the ACH system that dominates the U.S. market today?
It's the question every investor is asking right now, because for half a century, the entire banking system has operated on this delayed batch process schedule.
Right.
And moving to a real-time instant settlement model breaks that legacy operating cadence completely.
Which scares a lot of these institutions.
Oh, they are terrified.
Oh.
I mean, it completely shifts fraud liabilities in ways that mid-sized banks are frankly not prepared for. And it creates an entirely new set of winners and losers.
You've got the mega banks, the regional credit unions, and the core technology software providers that sit right between them.
Exactly. All of them are fighting for leverage as this new plumbing is laid down.
Well, let's strip away the vendor marketing fluff right out of the gate, because every financial tech startup claims they are, revolutionizing payments.
Yeah, it's a great pitch for a slide deck.
Right. But market reality is dictated by unit economics and technical friction. So what exactly are these systems?
Okay, so when the Federal Reserve talks about FedNow, or when that consortium of major banks talks about their real-time payments network, RTP, they are describing instant gross settlement payment systems that run 24/7/365.
And gross settlement is the operative term there, right? Because legacy systems like ACH do not settle gross.
No, they settle net. So ACH bundles hundreds of thousands of transactions together throughout the business day.
Like a giant digital snowball.
Exactly. And then they calculate the net difference between the participating banks, and they settle that final netted amount later in a massive batch.
Which is incredibly efficient for bulk data.
Yeah, it's highly efficient.
Yeah.
But it requires that time delay. FedNow and RTP operate on a completely different paradigm. They clear and settle transaction by transaction individually in literally seconds.
And they do this regardless of business hours.
Right. Midnight on a Sunday, Thanksgiving morning, it does not matter. When a transaction occurs on these networks, the funds are immediately, irrevocably available to the receiver.
So there's no pending status?
None. The money has changed hands at the central bank level instantly.
Okay, so the technical architecture here dictates the commercial reality. Let's drill into those mechanics.
Sure.
The first critical mechanic that you really need to wrap your head around is that these are strictly credit push systems.
Yes. This is massive.
You absolutely cannot pull funds from an account on these rails.
Right. Exactly. In legacy ACH, you have debit pulls. So if you have a corporate gym membership or a utility bill, the billing company basically reaches into your checking account and yanks the funds out on a scheduled date.
Because they have your routing number on file.
Right. They initiate the pull. But instant payment networks, both RTP and FedNow, explicitly prohibit this. They are credit push only. The payer has to physically or programmatically initiate the transaction and push the funds outward.
Because the systemic risk of allowing debit pulls on an instant network would be unmanageable.
It would be catastrophic. I mean, if a fraudster or just a compromised vendor system could instantly pull funds from your corporate treasury account with zero delay and zero ability to reverse the transaction, The banking system would collapse overnight.
Right. So think of a debit pull like a bouncer at a bar taking money out of your wallet to settle your corporate tab.
That's a good way to look at it.
He requires your prior permission on file to do it. But if he takes too much or pulls it on the wrong day, you can dispute it the next morning.
Yeah, you call your bank, trigger a chargeback, and claw it back.
Exactly. But a credit push is you physically taking the cash out of your wallet and handing it to the bartender.
Right.
The moment it leaves your hand, the transaction is over. It is immediate, final, and irrevocable. You can't just reach across the mahogany and snatch that cash back out of the register.
No, you can't. And to build on that bartender analogy, imagine handing the bartender that cash, but the bartender is wearing a blindfold.
Oh, wow. Okay.
Yeah, so if you hand the cash to the wrong person, or you were tricked into handing it to someone impersonating the bartender, the money is still gone.
Because the transaction is irrevocable.
Exactly. So because of that, the system requires this incredibly sophisticated layer of communication to ensure everyone agrees on exactly what is happening, who is who, and what the money is for before the cash is actually pushed.
Which brings us to the underlying language of these systems, right? ISO 2022.
Yes, the acronym every banking vendor is throwing around on their earnings calls right now.
Both FedNow and RTP run on it.
They do. It's the international messaging standard that actually makes the instant push possible.
Wait, hold on though. ISO 2022. Let's strip away the enterprise software marketing for a second. Is this just like a glorified text message format for banking?
No, not at all.
Because from an investor's perspective, a new messaging format doesn't sound like a catalyst for margin expansion.
Right. I get why it sounds like just a formatting update, but it's much more than a text message. It is a massive, structured data payload that physically travels with the money.
Okay, how is that different from what we do now?
Well, in the old system, a payment and the information about that payment traveled separately. So you'd get a wire transfer hitting the bank account and then an email with a PDF invoice trying to explain what the wire was for.
And some poor back office analyst had to match them up manually.
Exactly. ISO 2022 embeds all that rich data directly into the payment instruction itself. Different types of messages have these specific standardized codes.
Right, like the PAX.008.
Yes, PAX.008. That's the code for a customer credit transfer. That is the actual instruction from the sender's bank saying, move the money.
But we just established this is a credit push only system. A biller cannot pull the money. So how does a vendor actually ask a client for payment?
Good question. They use a pain.013 message.
Pain.013.
Right, which stands for a request for payment, or RFP. The vendor sends this pain.013 message through the banking rail itself, not an email.
So the client receives it directly in their banking portal.
Exactly, or right into their ERP system. And here's where that margin expansion you asked about comes in. That message contains the exact invoice number, the line items, the due date, and even discount terms embedded right in the code.
Oh, I see. So if the client's automated system reads it and approves it, it instantly fires back a PAX.008 credit push.
You got it. And because that pain.013 message carries all the exact invoice data alongside the payment request, a corporate treasurer doesn't need an army of accounting clerks to reconcile payments on Monday morning.
The enterprise software just reads the ISO code and reconciles the ledger instantly without human intervention.
That is exactly where the cost savings actually live. It's not in the transaction fee itself. It's in stripping out all that back office overhead.
That makes a ton of sense.
And furthermore, you have this constant stream of status messages flying back and forth in milliseconds, like PAX.002 messages, which are real-time payment status reports.
Telling the sender if the transfer was actually accepted.
Right, or rejected because the account was closed, something like that. You even have CAM.056 messages.
Wait, what are those?
Well, since you cannot pull money back, a CAM.056 is a formal automated request asking the receiving institution to kindly initiate a brand new credit pushback to the sender because an error was made.
Ah, so it's an automated way of saying, oops, please send that back.
Exactly. This incredibly dense automated data environment is what theoretically allows large corporates to just gut their back office costs.
Okay, so that covers the communication layer. But if you are analyzing the systemic risk, you really have to look at where the actual money sits during these milliseconds.
Yes.
Where is the settlement actually occurring?
So the settlement architectures differ between the two networks, and it creates massive liquidity headaches. But both ultimately rely on the Federal Reserve at the base layer.
Right. Let's start with FedNow.
For FedNow, Transactions settle directly to and from each participating financial institution's master account held at the Federal Reserve.
So it's just central bank money moving from one Fed account to another.
Exactly. But for the RTP network, which remember is run by the private clearinghouse, transactions settle within a separate pre-funded joint balance account owned by the Federal Reserve Bank of New York.
Pre-funded, that's the key word.
Yes, every bank participating in RTP has to pre-fund their portion of this joint account using FedWire.
Look, if I am a regional bank treasurer, that sounds like an absolute nightmare.
Oh, it is.
Because FedWire closes on weekends and holidays. So if my retail customers decide to go on an instant payment spending spree on a 3-day holiday weekend, and I haven't pre-funded enough liquidity in that RTP joint account on Friday afternoon,
your customers' transactions will start failing on Sunday.
just because I'm out of pre-funded capital at the Fed, that's brutal.
It's the exact liquidity trap regional banks are facing right now. To mitigate this, FedNow introduced liquidity management transfers, or PACS 009 messages.
Okay, another acronym. What do those do?
They are instant, large value money transfers between banks, or from a bank's master account into the joint account for private sector services like RTP.
Oh, so they allow institutions to move wholesale liquidity around instantly, 24/7.
Right, to ensure they have the funds available to settle these real-time retail and commercial transactions. But there's a catch.
Which is?
It requires the bank to have a treasury team or some highly sophisticated automated algorithm actively monitoring and sweeping liquidity on a Sunday morning.
And traditional banking infrastructure was simply not designed to manage liquidity outside of a Monday to Friday 9 to 5 window.
Not even close.
So who is actually facilitating all of this integration? You have the operators, the Federal Reserve running FedNow, and the clearinghouse, which is essentially a private consortium owned by, 22 of the largest global banks operating RTP.
Right.
But the critical players for broad U.S. adoption, the companies that investors are actually trading, are the middlemen, the core banking software providers.
Absolutely, because the vast majority of the roughly 9,000 depository institutions in the U.S., we're talking the community banks, the regional credit unions, they possess nowhere near the technical capability or the capital to build direct, automated 247 API connections into the Federal Reserve.
Or the clearinghouse.
Right. Their legacy mainframe systems are built for 1980s batch processing, so they are entirely captive to their core processing providers.
We are talking about the big three here, FIS, Fiserv, and Jack Henry.
Yes, those companies act as the mandatory gateway. They operate modern payment hubs that intercept that 24/7 instant ISO 2022 messaging. They translate it and they manage the balances until the bank's legacy mainframe comes back online to post to the actual customer accounts.
Which is wild, but listen, if the underlying technology to move money instantly is this complex and requires this much middleware, it begs a massive historical question.
Which is, why did it take so long?
Exactly. The United States possesses the most sophisticated, highly capitalized, aggressive financial markets on the planet. Yet, until late 2017, a digital transfer between two consumers at different banks over a weekend was a complete illusion.
Yeah.
Why did it take the U.S. so long to adopt real-time architecture compared to the rest of the developing world?
Well, if you trace the evolution of U.S. electronic funds transfer, you actually see that our early success became our biggest handicap.
We were victims of our own success.
Precisely. We moved from paper checks to the automated clearinghouse back in the 1970s. And ACH was revolutionary at the time. It allowed for high-volume, automated batch processing of payroll, Social Security checks, utility bills.
Right. But it was inherently constrained by the computing power of the era.
Exactly. It required physical business hours, dedicated clearing windows, and overnight batching just to ensure the ledger's balanced.
Now, I can hear the counter-argument from the trading desk already. People will point out that we have had FedWire for decades, and FedWire is a real-time gross settlement.
It is real time, but it is strictly a wholesale system. It is built for a bank to move $50 million to another bank to settle a massive trade.
Right. It operates on a highly restricted schedule. It's firmly closed on weekends and federal holidays.
And it is prohibitively expensive per transaction. It's categorically not designed to handle the massive volume of low-value retail transactions, like, a consumer buying a coffee or splitting a dinner bill.
Which created this massive real-time gap in the U.S. retail and commercial space.
Exactly. And while the U.S. was resting on the laurels of its ACH and credit card networks, emerging markets were leapfrogging us entirely.
Yeah, the U.S. was a significant laggard here. Markets like the United Kingdom forced the issue with their faster payment system years ago.
But look at emerging markets, too. You have India with the Unified Payments Interface, or UPI, and Brazil with PIX.
Oh, PIX is incredible.
It is. These systems achieved instant, nationwide ubiquity years before FedNow even launched.
So why the disparity? I mean, is it just a failure of U.S. innovation?
No, it actually comes down to entrenched market structure and regulatory force. In many emerging markets, they completely lacked a legacy credit card infrastructure.
Oh, right. They didn't have point-of-sale terminal networks hardwired into every single corner store?
Exactly. So when smartphones became ubiquitous, those central banks leapfrogged the plastic card phase entirely. They just built instant, mobile-based payment rails from scratch.
Because they had a blank slate.
Right. Furthermore, in places like Brazil and India, the central banks utilized aggressive regulatory mandates. They legally forced the largest financial institutions to integrate with PIX and UPI immediately.
Which naturally drove overnight consumer adoption.
Yep. But in the U.S., our regulators generally avoid forcing private banks to adopt new technology.
So it has been an entirely fragmented, market-driven slog here.
That is the crux of the delay. The turning points here are highly specific. November 2017 was the first real move. That's when the clearinghouse launched the RTP network.
And that was the first new core payments infrastructure built in the U.S. in, 40 years?
40 years, yeah. But remember, the clearinghouse is owned by the mega banks, so that thousands of smaller community banks looked at RTP and just blocked.
Right, because they feared that routing all their customers' instant payment data through a network owned by their biggest competitors, like JP Morgan and Bank of America, was basically a strategic death sentence.
Exactly. They wanted a neutral party, which forced the government's hand.
So we jump forward to July 2023, and the Federal Reserve finally goes live with FedNow.
Right. The Fed had to step into this space directly to ensure equitable access. They realized that a system run solely by a consortium of the largest banks would never be trusted by the regional players.
And without the regional players, you never achieve ubiquity.
Exactly.
So now that the dual infrastructure is actually in place, the market expectation, which is being heavily pushed by sell-side analysts covering these tech vendors, is that we are going to see a massive, immediate migration of payment volume away from legacy systems to these new instant rails.
Yeah, that's the narrative.
But the narrative completely falls apart when you look at the actual unit economics. So let's address the great debate for investors right now. Will instant settlement actually replace ACH?
The short answer is absolutely not. Not for a very long time, and certainly not for the bulk of commercial volume.
To understand why the analyst projections are so overly optimistic, you have to distinguish between theoretical engineering capabilities and brutal market reality.
Right, because ACH is protected by massive economic and utility moats that instant payments simply cannot breach with their current pricing structures.
And we are talking about fractions of a penny here, but if you are modeling the operating leverage of a major payment processor, those fractions scale into millions of dollars of margin destruction.
Let's walk through the exact math on this mode. Look at the wholesale network costs. The Federal Reserve charges a participating bank approximately 0.03035 per standard ACH payment.
Okay, so that is roughly 1/3 of a single cent.
Right. Now, in contrast, FedNow charges 0.045 per transfer.
4.5 cents.
And the RTP network charges a similar flat fee of 4.5 cents.
Look, 4 cents sounds absolutely negligible to a retail consumer.
But apply that to commercial scale. Imagine you are the corporate treasurer for a massive enterprise processing a bi-weekly payroll run for, say, 1 million employees.
Okay, let's run the numbers. If I run that 1 million transaction payroll file through legacy ACH, it costs me roughly $3,500 in base network fees. If some tech consultant convinces me to modernize and run that exact same scheduled payroll through FedNow, my network cost spikes to $45,000.
For the exact same result.
Why on earth would any corporate treasurer accept that margin compression for a scheduled disbursement?
They wouldn't.
Because the employees know exactly when they are getting paid. The speed of settlement provides zero additional utility for a scheduled event like payroll.
Exactly. They won't accept it. That margin difference is absolute destruction to the bottom line of a payroll processor like ADP or Paychex or any large enterprise.
Yeah, it makes no sense.
And the gap is even more egregious when you look at the premium banks are charging their end users. The median price a commercial bank charges a business client for processing an ACH transaction is roughly 40 cents.
Okay.
The median price they are currently charging for an instant payment origination is nearly $2.50.
Wow.
You are asking businesses to pay a 500% premium for instant settlement speeds that they fundamentally do not need for accounts payable.
And beyond the sheer unit cost, you have the transaction limits, which completely price these instant systems out of the wholesale commercial market anyway.
Yeah, the limits are a huge bottleneck right now. Traditional ACH can handle individual transactions up to $100 million, even same-day ACH, which is an accelerated batch process, but still legacy infrastructure handles up to $1 million per transaction.
But the instant networks are severely constrained by their risk models, right?
Very much so. RTP only recently raised its transaction limit to $1 million. FedNow is currently hard capped at $500,000, and many participating institutions manually lower that limit to $50,000 or $100,000 based on their own internal fraud risk profiles.
So if you are settling a large commercial real estate transaction, funding an escrow account, or sweeping serious corporate treasury funds, instant payment rails are functionally useless right now.
Basically, yes.
And costs and limits aside, there's a massive operational utility moat. We keep framing the batching of ACH as an outdated 1970s limitation. But if you talk to anyone running back office finance for a Fortune 500 company, batching is actually a feature, not a bug.
It is the core feature of corporate finance.
Yeah.
ACH is purposefully built for bulk.
Right.
Enterprise resource planning systems,
Right.
the massive Oracle and SAP software installations that run the finances of global corporations are deeply structurally integrated with batch processing logic.
So throughout the month, the ERP compiles thousands of individual payables into a single massive formatted file.
A Nesho file, yeah. And it transmits it to the bank once. The instant payment systems currently require transaction-by-transaction processing. The network wants 1 million individual instant messages, not one file with 1 million instructions.
And if an ERP system tries to unpack a massive batch file and fire off 1 million individual instant API calls to a bank, it completely overwhelms the local server.
Oh, it would crash it.
And more importantly, it breaks the reconciliation logic when those million individual status reports start firing back asynchronously in milliseconds.
Exactly. Until the network operators and the software vendors develop standardized bulk processing protocols that can efficiently bridge batch logic with instant messaging without breaking. The ERP's brain, massive corporate disbursements, are trapped on ACH.
So ACH isn't going anywhere for payroll, government disbursements, or bulk payables. It is just too cheap, its limits are too high, and it integrates too well with legacy corporate software.
Exactly. ACH is safe for now.
Okay, but if ACH is safe, where are the disruption vectors? If you are an investor looking at the payment space, where should you actually be looking for payment volume to migrate to RTP and FedNow? Right, because the utility can't reach in and pull the money.
Exactly. So RFPs are the technological workaround attempting to mimic ACH's recurring debit feature securely.
How does that actually work without violating the credit push rule?
Imagine a utility company. Instead of pulling your monthly bill via ACH, they set a $0 RFP to your banking app when you first set up the account.
Okay.
Your banking app prompts you. Do you authorize this utility to send you payment requests? And do you authorize us to automatically approve those requests as long as they were under $200 and only arrive once a month?
Oh, interesting. And you just hit yes.
You hit yes. Now, every month, the utility sends a paying .013 RFP for your specific bill amount. Your bank receives it, checks the parameters you pre-approved, and instantly fires off the credit push.
So it's an automated credit push disguised as an auto draft.
Exactly. If this framework gains standardized traction, massive volumes of recurring consumer bill pay could migrate away from ACH and, more importantly, away from credit cards.
Which brings us to the second vector, the absolute holy grail of payments disruption, merchant services compression.
Oh, this is the big one.
Because every single time a consumer swipes a Visa or MasterCard, the merchant pays a merchant discount rate, an MDR, and that's often between 2% and 3% of the total transaction value.
Right. And instant payments offer a dramatically cheaper direct-to-bank alternative to those traditional credit card rails.
This is where the landscape gets incredibly dangerous for the legacy card networks.
Very dangerous. Watch for major merchants, especially high-volume, thin-margin retailers like grocery chains and gas stations, beginning to heavily incentivize customers to pay via pay-by-bank instant transfers directly at the point of sale.
Right. If a merchant can bypass the credit card networks entirely and route the payment instantly from the consumer's bank account directly to the merchant's bank account using RTP or FedNow, they completely eliminate that 3% swipe fee.
And 3% margin in the grocery business is massive.
It's the entire profit margin. So to incentivize the consumer to actually stop using their rewards credit card, the merchant might offer a 1% immediate discount at the register if you use the Pay by Bank QR code.
Right. The consumer gets a cheaper card, and the merchant still captures an extra 1.5% to 2% of margin they use to hand over to the card networks.
It's a win-win for everyone except Visa and MasterCard.
And that is precisely what occurred in Brazil. The Pix system was so efficient and so cheap that merchants pushed it relentlessly. It completely upended the merchant acquiring model and severely compressed the growth of traditional credit card volume in that country.
And U.S. merchants are desperate for a similar weapon against interchange fees.
Absolutely desperate.
But that transition requires the U.S. banks to actually play ball and enable the technology, which brings us to identifying the infrastructural winners and losers in this shift.
The toll collectors.
Right, the toll collectors. We touched on the core banking providers earlier, FIS, Fiserv, Jack Henry. If you are holding these stocks, why are they positioned so perfectly to extract value from this transition?
Well, think about the thousands of smaller depository institutions in the U.S. As we established, they cannot build direct API connections to the Fed.
They don't have the engineers or the capital.
Exactly. They are captive. They have no choice but to pay their core providers to upgrade their legacy systems. And the engineering challenge is immense.
Because of the 2 a.m. batching window?
Right. These regional bank legacy mainframes were specifically designed to take the entire banking system offline at 2 a.m. every single night to batch process the day's ledger files.
And you physically cannot take a banking ledger offline for maintenance or batching if the Federal Reserve mandates that you must be ready to accept, post, and settle an instant payment at 2:05 a.m.
You can't. It violates the network rules.
So the core provider has to build a modern architectural wrapper around the 1980s legacy system.
Exactly. They build and sell what's called a payment hub. This hub operates 24/7 in the cloud. When the bank's main ledger goes offline at 2 a.m., the payment hub acts as a shadow ledger.
Ah, shadow ledger.
Yeah, it intercepts incoming FedNow and RTP instant payments, holds the data, updates the customer's available balance in their mobile app so it looks instant, and then physically reconciles with the bank's main core ledger when it boots back up the next morning.
That is incredibly clever.
It is, but the regional banks have to pay these core providers massive upfront implementation fees, ongoing integration fees, and recurring per-transaction network fees just for this capability.
So the core providers are essentially selling the pickaxes, the shovels, and the maps during the instant payments gold rush.
And they hold a completely captive audience.
Look, if you are holding regional bank stocks right now, this integration cost isn't just a line item you can ignore. It is an existential threat to their operating leverage. How does this dynamic affect overall bank market share?
It accelerates consolidation, without a doubt. The mega banks like JP Morgan and Bank of America, they integrated early into the RTP network years ago. They had the billions in capital and the armies of internal software engineers to build those direct connections,
which allowed them to retain massive enterprise clients who demanded sophisticated instant liquidity management tools.
Right. Now, the smaller players, the community banks and regional credit unions, they view RTP and FedNow as a theoretical way to level the playing field.
Because if they connect, they can finally offer their commercial clients the exact same instant money movement capabilities as the megabanks.
But they face brutal margin-crushing integration costs to get there. It is an expensive technological arms race just to maintain parity and prevent their commercial clients from fleeing to the money center banks.
Wow. Okay, we have discussed the mechanics, the moats, and the margins. Now we need to address the dark side of this entire architectural shift.
The fraud.
Yes, the systemic risk factor, because the speed of money movement is now exactly matched by the speed of fraud.
And this is the existential threat to the rollout of instant payments globally. Authorized push payment fraud, or APP fraud. We established earlier that these transactions are irrevocable, blindfolded credit pushes. So if a fraudster uses basic social engineering, say a highly targeted phishing email impersonating a company's CEO, or a fake spoofed invoice from a known vendor, and tricks a corporate accounts payable employee or a retail consumer into initiating an instant payment.
That money is gone.
Instantly, irrevocably.
Because if a fraudster compromises a credit card, the consumer spots it, calls the bank, and Visa initiates a chargeback, the consumer is made whole.
Right.
And if a fraudulent ACH batch file is submitted, there is a multi-hour clearing window where behavioral algorithms can flag it, freeze the batch, and stop the settlement.
But with FedNow and RTP, it is final settlement in 2 seconds.
Yeah.
There's absolutely no clawback.
And the structural risk is that the instant networks explicitly place the liability on the banks and the consumers.
Yes, the liability shift is massive. If you, the account holder, authorize the push, even if you were psychologically tricked or socially engineered into doing it, the banking system functioned exactly as designed.
Because you authenticated the session and you pushed the funds.
Exactly. The networks will not reverse it. This brutal shift in liability is going to spawn a massive, high-growth sub-industry focused purely on real-time fraud prevention, behavioral biometrics, and digital identity verification.
Because you literally cannot rely on overnight batch fraud screening anymore.
No, it's too late. The AI underwriting models have to analyze the device, fingerprint, the behavioral biometrics of how the user is holding the phone or typing, the historical context of the payee, and the network risk score.
And they have to do all that and make a definitive approve or decline decision in milliseconds.
Right, before that ISO 2022 message is allowed to leave the bank's server. The vendors supplying those millisecond AI fraud models are going to see massive demand from terrified regional banks.
I need to interject here, though, and highlight what is probably the single biggest structural headwind to true ubiquity in the U.S. market. It's something that just astounds investors when they first look at the U.S. payments landscape.
The interoperability problem.
Yes, RTP and FedNow are fundamentally, intentionally not interoperable.
It is a staggering friction point. Both networks use the exact same ISO 2022 messaging language. They format the data payloads the exact same way.
But they refuse to route messages to each other.
Exactly. An institution that is only integrated into the private RTP network cannot send an instant payment to an institution that only uses the public FedNow network.
So if I am sitting at Bank A, which paid millions to integrate with RTP, and I want to send an instant payment to my contractor who banks at Credit Union B, which only uses FedNow,
the transaction simply fails.
The pipes just do not connect at the central level.
No. This fragmentation forces banks to integrate with both distinct networks if they want to guarantee their commercial customers can actually reach any endpoint in the country.
Which literally doubles their integration costs, their liquidity management headaches, and their compliance overhead.
The Federal Reserve has offered, some vague public commitments to eventually working towards some form of interoperability. But the technical, legal, and risk management nuances of physically connecting a private consortium network owned by the megabanks with a sovereign central bank network.
I mean, that means we are likely years away from a unified, interoperable rail.
Easily. And until that bridge is built, the U.S. market remains highly fragmented, which severely stunts the network effects required to challenge credit card dominance.
Okay, we have covered the underlying database mechanics, the brutal unit economics, the vendor toll collectors, and the systemic fraud risks. It is time for the one question.
Let's hear it.
What is the single punchy question you should always ask when you hear a fintech executive or a bank CEO boasting about their instant payment strategy on an earnings call?
The question you must ask is this. If a financial institution or payment processor is boasting about massive growth in instant settlement volumes, are those transactions actually displacing expensive credit card rails, or are they simply cannibalizing their own dirt-cheap ACH volume?
Because if a bank is simply moving its existing corporate payroll clients from a batch system that costs fractions of a penny into an instant system that requires massive 24/7 compliance, cloud infrastructure, and liquidity overhead,
their operating costs go up exponentially, while their revenue likely stays completely flat.
That is margin destruction disguised as innovation.
Exactly. You want to look for institutions and processors that are strategically using instant payments to capture net new volume that previously went through high-fee credit card networks.
Or banks that are utilizing the data-rich ISO 2022 messaging payloads to sell premium automated cash management and reconciliation services to corporate treasurers.
Right, because if they aren't generating new fees or bypassing card networks, instant payments are just an expensive compliance tax.
All right, let's recap the critical takeaways from this analysis. Number one, instant settlement via FedNow and RTP represents a permanent, irreversible architectural shift to 247 credit push liquidity in the U.S. financial system.
But the complete lack of interoperability between the private and public networks remains a severe structural choke point stunting adoption.
Number two, ACH is not dying anytime soon. Its massive transaction limits, its inherent bulk processing capabilities that integrate perfectly with enterprise software, and its near zero unit costs ensure it will remain the dominant rail for payroll and large corporate disbursements for the foreseeable future.
And number 3, the immediate actionable investment opportunities aren't necessarily in the payment networks themselves, but in the toll collectors.
The core banking software providers building the payment hubs and the real-time AI fraud prevention vendors required to make this entirely new, irrevocable plumbing safe and operational for terrified regional banks.
Spot on. And as always, we have to remind you that Talk Tickers provides this analysis for informational purposes only. We are breaking down complex market mechanics and infrastructural shifts, not issuing formal buy or sell ratings on any specific equities mentioned today.
We've spent this entire time analyzing the friction of upgrading legacy fiat rails. But consider this. If FedNow and RTP failed to achieve rapid, seamless ubiquity across the U.S. economy because of these absurd interoperability bottlenecks and massive integration costs.
Did that infrastructural failure inadvertently create the perfect regulatory vacuum for a U.S. dollar stablecoin to become the de facto interoperable instant settlement rail for the private sector?
If the banking pipes won't connect, the market will eventually route around them. Something to think about the next time you hit send. Thanks for listening, and we'll see you on the next deep dive.